Here is a question worth sitting with on Friday, the 31st of July 2026. Gold is supposed to be the ultimate safe haven, and yet it is ending the week on the back foot once more. FX Street reported this afternoon, at around 2:45 UK time, that gold is declining as a firmer US dollar and a hawkish Federal Reserve outlook weigh on the metal. That is not a one-day story. It is the same two words, dollar and Fed, that have been driving bullion lower on and off since the middle of June. Just a fortnight ago, on the 17th of July, gold was trading below the $4,000 an ounce mark for precisely the same reasons. So if you own gold, or you are thinking about buying it, the useful question is not whether gold is falling. It is which specific force is pushing it down, and what would have to change for that force to ease. That is what we are unpacking today. Start with the dollar, because it is doing most of the damage. Gold is priced in US dollars on the global market, so when the dollar strengthens, an ounce of gold becomes more expensive for anyone holding euros, yen, rupees, or pounds. Demand from those buyers softens, and the dollar price adjusts downwards. Reuters reported on the 28th of July that the dollar was hovering near a one-month peak, and that firmness has carried through to the end of the week. The second part of the mechanism matters even more. Gold pays you nothing. No coupon, no dividend, no interest. When investors expect US interest rates to stay higher for longer, holding a zero-yield asset carries a real cost, because that same money could sit in treasuries or a money market fund earning a return. Rising real yields, meaning yields after inflation, are historically the single most reliable headwind for bullion. Right now both levers are pushing the same way. So what actually changed? The catalyst has been the Federal Reserve. Markets went into this week focused squarely on the Fed's policy meeting, with both CNBC and Reuters noting on the 28th of July that gold was slipping while traders waited for the decision. The messaging around that meeting has been read as hawkish. In plain English, hawkish means policymakers sound more worried about inflation than about slowing growth, and therefore less willing to cut interest rates quickly. Every time that view hardens, traders push back the expected timing of rate cuts. Futures markets reprice, the dollar firms, and gold gets marked down almost mechanically. This is the same pattern CNBC described back on the 18th of June, when gold was on track for a third consecutive weekly loss on a firm dollar and hawkish Fed signals. 6 weeks later, the script has barely changed at all. It is worth laying the timeline out, because the repetition tells you something important. On the 18th of June, gold was heading for its third weekly loss in a row, blamed on a firm dollar and hawkish Fed signals. On the 23rd of June, it slid to a near 2-week low on the same combination of rate expectations and dollar strength. On the 17th of July, it slipped under $4,000 an ounce, again with the dollar and the Fed named as the culprits. And today, the 31st of July, the headlines are almost word-for-word identical. That consistency is the point. This is not random noise or a single scare. It is a sustained repricing of interest rate expectations, and gold happens to be on the wrong side of it. When one driver dominates a market for 6 weeks, it usually takes a change in that driver, rather than a headline from somewhere else, to turn things around. Here is how that lands closer to home. Most UK investors hold gold through exchange-traded funds, through physical coins and bars, or as a small allocation inside a pension or an ISA. If your holding is priced in dollars, you are getting two effects at once. The dollar gold price is falling, which hurts, but a stronger dollar means each dollar converts into more pounds, which cushions the blow in sterling terms. That currency buffer is why some British holders will see a smaller loss on their statement than the headlines suggest. For anyone buying rather than holding, the picture flips. Gold below $4,000 is cheaper in dollar terms than it was in the spring, but the sterling cost of buying is being propped up by that same firm dollar. And do bear in mind the practical costs. Dealer spreads on physical coins, secure storage, and ETF management fees all bite harder when the metal is not rising. The effects spread well beyond the metal itself. Gold mining shares tend to be geared to the gold price, so a fall in bullion typically hits miners harder than the metal, because their profits are the gap between a largely fixed cost base and a moving selling price. Jewelry demand, especially in India and China, which together account for the bulk of global consumer buying, often picks up when prices dip, and that physical demand can quietly put a floor under the market. Central banks are the other major buyer, and their steady purchases have been a structural support for bullion in recent years. Meanwhile, a firmer dollar is not just a gold story. It squeezes emerging market borrowers who owe money in dollars, makes American exports pricier abroad, and tends to weigh on other dollar-priced commodities, including oil and industrial metals. Gold's decline is one visible symptom of a much broader currency move. So where does this go next? The honest answer is that gold's near-term direction is now largely a bet on the Federal Reserve and on the data that shapes it. Watch three things. First, U.S. inflation prints. A soft reading revives rate cut expectations, weakens the dollar, and is the fastest route to a gold rebound. A hot reading does exactly the opposite. Second, the U.S. labor market. Signs of rising unemployment would push the Fed towards cuts and support bullion. Third, the dollar itself. As long as it holds near the one-month highs seen this week, rallies in gold are likely to be sold into. There is a counterweight, though. Central bank buying and geopolitical risk have repeatedly stepped in when prices dip, which is why gold has held four-figure territory rather than collapsing. Expect a market that is choppy and headline-driven, rather than one moving cleanly in a single direction. Here is the takeaway to hold on to. Gold is not falling because something is wrong with gold. It is falling because the two things it competes with, cash yields and the dollar, have both become more attractive at the same moment. That is a relative pricing story, not a broken safe haven. For long-term holders, the modest allocation that many advisors suggest, often cited somewhere in the 5 to 10% range, is meant to work like an insurance policy, and insurance looks boring or even disappointing while everything else is calm. Judging it on a 6-week drawdown rather misses the point of owning it. For anyone tempted to trade this, respect the trend. The market has punished dollar-denominated gold repeatedly since mid-June, and the underlying driver has not yet changed. Keep your eye on the economic calendar rather than the noise. Inflation data and the Fed's next signal will move gold far more than any single headline.